3, 2, 1.
And we're live.
Love the countdown. Hello, everyone, and thank you for joining once again. Ben Richards and myself jump on every Friday at 5 p.m. to discuss the highs and lows and hopefully give you some valuable content on what we've been up to and what problems we've overcome, and also some potential wins that we've had. We've got a very busy agenda today, which we'll run through. So we are firstly going to kick off for a planning approval, which we achieved this week. So we'll be sharing that. We'll be sharing a plugin solution to fire and lighting for your developments. We'll be going into, I suppose, a synopsis and a summary of our supported living and social housing portfolio. We've been talking about it quite a lot, and we thought it would be good to explain it from basics and to explain how it works. There's an awesome house extension that Aura did, which will be showing you what that looks like. I don't know how many calls we've done this week, at least a dozen on raising funds. So we're going to bigger pots of funds and what we have been up to and what that might look like for us. We have had a valuation done on a site in North London, a £1.5 million redemption this week. We're going to go into sales tips and how we've sold 4 of our 6 assets pretty quickly in what would be meaning as a potentially tough market off the back of the good market we've had for the last couple of years. Investor heads of terms is something we send out. Why do you need investor heads of terms and why are they beneficial? So definitely hang around for that. And I had the pleasure of attending a residents meeting this week. And then last but not least, we will be coming back to all the questions that have come in since our last live. So we'll be excited to get onto that. And here's a snippet of some of the questions. So why would you fix or ride a tracker mortgage currently? Obviously, we had a base rate rise yesterday of 25 basis points, what that may mean. And we had a question of monthly Matterport costs. So we'll explain what a Matterport is and why you might be paying monthly for it. That I suppose is this double coin really, because XP Property have Matterports for our properties, Central Suites have Matterports for our properties, but XP Surveys has the kit and that is one of our products.
Cool, good stuff. I'll jump into this one. Success, excellent news. This week we had the final approval through for 20 units under Class MA to convert this beautiful office building into residential flats. Now, if you tuned in last week or if you missed last week, tune into last week's episode, which is episode 27, where we talk about in depth the case law, which is on our screen, which is an appeal decision that allowed us to push this through and effectively go from a no, this is going to get rejected, to a actually, this case law means that we have to approve it and put a condition on your approval. So really great news, 20 units approved and locked in for the old Maltings in Abingdon. So stay tuned as that one progresses. We're about 80% of the way through the tender package and should be going out to tender in the next week or 2. Super exciting. Second on the list, Lumi Plugin. Would love to know in the comments below if you've heard of them, or even better, if you've used them. Aura had a very interesting CPD, which is continuous professional development power hour, whereby the Lumi Plugin director came in and talked us through this system. Jack, have you seen these before?
Nope.
So I about 4 years ago, when this company was just starting up, I think they're now 7 years since its inception, and 4 years ago they really started launching to the market. They came into our Aura office then. They're on Mark 3, Mark 4, version 3, version 4 of kind of the development of this now. But effectively, the problem that they're solving is walking into a house, walking into a development, looking up at the ceiling acne that is often jumbled up with smoke detectors, heat detectors, sprinklers, PIR systems, all that type of stuff. Effectively, what they've done is brought all of those separate systems into a light fitting. So you see the LED rings on the right hand side. This is your general LED lighting function and has a very, very wide beam. But in the center of it, there is an interchangeable piece which either houses the PIR, the smoke detector, the sprinkler system, the heat detector, or any other things that they've got on their list of products. So very, very neat system, reduces the amount of cabling you need in your property, reduces the amount of ceiling acne on the ceilings, and yeah, is a really clean, crisp product that creates far less clutter on your ceilings. So yeah, if you use these, we'd really love to know. We're getting some finer details on these systems in terms of costings and the product itself being sent to us. We're actually looking at potentially installing these in the old maltings in the project that we just spoke about. So stay tuned for more on Lumi Plugin.
Nice, like it a lot. So supported housing explained. We actually have a team review which we did only a couple of weeks ago, and still some people in our team, even Ben and myself to some degree, still struggle to get a head around what we're doing and what that looks like. But about 3 years ago, we brought together the theory and the sort of strategy to grow a social housing portfolio fundamentally. Ben and I and XP are a quarter shareholder. We were brought in as supposedly the delivery partners, the construction and project management. And for the best part of 2.5 years, we have been delivering the portfolio that you can see on the screen, predominantly in South London regions, Croydon and Lambeth. And long story short, we as landlords or property investors would buy it might be old B&B, it might be an old care home, it might just be a residential house, or it might be a very large HMO or even a small HMO. When we see the property, we would send that over to our mandated housing association partner to get their approval for the asset. What they're looking for is the location, the rates that they would be achieving on the specific floor plans that we put across in principle, that they have a relationship with that council and demand in that council. They would also be looking at the type of stock that we're delivering. So we, and if anyone's following this market, Home REIT have obviously been caught out for not really doing DD and supplying not only the service of pastoral care or the care that the tenants need, but also doing the DD on the assets, the size of the assets, the bedrooms, what those assets offer the tenants. So we wanted to go in and do this properly, actually prehistoric to other people in the industry not doing it properly. So once the housing association approved the asset, the layouts, we would then go ahead and buy that and use our technical team and our delivery team and our construction contacts to deliver those assets. Almost the week it's finished, practical completion, we give the housing association a heads up weeks before, and they then are our tenants that house those properties. So we're the landlord, the housing association are our tenants, and obviously their tenants are the vulnerable people living in the properties. So it's great from an ESG and giving back perspective. Why would we do it? It's more secure rental income. It's government supported, so that the council pull the finance from Universal Credit. The housing association have an agreement with the council. They then receive the rent roll from the council and the care provision, and then they then pay the local housing allowance rate that we had agreed onto us as the property landlords, property owners. So it's almost like an HMO, but we have one tenant. The way I like to phrase it is a residential asset with a very commercial focused lease. The lease is predominantly anywhere. We've seen leases from 2 years, 5 years, 10 years, 15 years, 25 years. I've even heard of a lease that's 100 years, and that is a fully repairing. Ours is internally, some are externally, lease that the housing association take on that responsibility. For them, it's good. They get comfort that they've got the asset for a surmountable amount of time, and they can really get into solving the problem that obviously faces in unfortunately, all of our counties across the UK, and is a very, very big supply and demand gap that is missing there. Where do we come in as developers, and what's in it for us? Obviously, the obvious solution for us is that part of giving back. And in concept, it was great, but in principle, now we've actually delivered the assets. It's actually really nice to see people get back onto their feet and have some responsibility in their own space to drive on, and in reality, be less of a burden on the taxpayer, because our room rates are nowhere near hotel room rates. I think our rooms are less than one night in a hotel than we pay for a week. So it's a great product all around, and we've been building this successfully for the last 2.5 years. Where times have changed, and I'll talk a little bit about exit, Ben, if you didn't want to add anything to that.
No, crack on. I mean, I think the as far as what XP have done and Aparo Social, which is the venture that has gone into this supported housing venture, we've bought 14 assets over the last 2.5 years. We have 114 beds amongst those, so bed sits, and the value of that is around £22 million. So no mean feat, and something that we're super proud of, to be housing 114 vulnerable tenants. I think not sure if Jack did mention, but the sort of type of tenant in our portfolio is more ex-domestic violence victims, ex-military, people with special educational needs, and people trying to transition into to normal life from hardship and difficulty. So yeah, we're super proud of what we built, and yeah, worthwhile definitely touching on the exit.
Yeah, cool. So the exit is where it gets complicated. So we've basically built, as I mentioned, a HMO portfolio that's got an income that's more secured than a privately run HMO room where you might have one tenant leave and they're on their AST. So we have 14 assets, 14 leases, technically 14 tenants, which are the same housing association. So where exit comes in is, and the exit is a bit convoluted of late because a lot has been going on in this market. So the way that a firm like us would actually look to exit this portfolio is, one, just to refinance and hold, and that's probably the current agenda for us at the moment because the market is pretty uncertain, and I'll come on to that shortly. But another way that you exit this type of portfolio is you sell the rent roll, you sell the yield. So on our £22 million portfolio, we have £1.2 million net income. And because it's got to a critical mass where it is attractive to insurance companies, pension funds, family office funds, we can sell our portfolio and the income, which is government supported and secured on a lease. And it's fairly hands-free because the housing association take on obviously the responsibility of the assets and also the tenants. And if that bedroom is not filled, the housing association still pay the room rates. We can then compress that yield and sell that for a valuation so that big buyers that are looking for residual income, no build risk, no management of properties, no estate agents to deal with, no void rates to deal with, they can buy that income off us. We had some good potential buyers in the market. I'm talking about a year ago. But the reason that we might be looking to hold is Home REIT, which is the largest UK-based real estate investment trust. That's probably another topic for another day, which are also known as a REIT, have basically been called out for not doing what they're supposed to be doing. All of their, because they were the first, obviously, largest REIT on the stock exchange. They have to take care of their stakeholders, and they were not doing the due diligence or the care that they should have been doing in this space. I must say it is a very interesting space to be in because there's some people in this space that are doing it for the ESG credentials and doing it for the well-being of our country and the people that need it. And there's others that are arbitraging the sort of the value and not necessarily taking care of the most principal element first. So we like to work from the bottom way up and take care of the tenants first because then the investment is more attractive. So the market has slid away a bit and yields have moved. Part of that is because the biggest player in the market has been called out, and part of that could be seen as interest rates going up because anyone buying this stock and leveraging this type of stock for that yield might actually need to basically pay less for the portfolio to get the same return because of interest rates. So I hope that is enough to give you a bit more of an overview. There is so much more to it, and we could spend an hour talking about the leases, an hour about housing associations, an hour about how housing associations become registered providers and what that means. But please keep the questions coming because we don't have a lot of time. We're conscious that everyone has a Friday evening ahead of them, and as do we. So we welcome questions on social stuff, and it's been an eye-opener to go into it. And if we haven't necessarily, I suppose, commercially exited as we had planned last year, at least we've learned a significant amount and obviously got quite a significant portfolio to back that up.
Nice. Good stuff. So I wanted to very quickly touch on the house tour that we launched through Aura this week. It's definitely been our best performing video, which is great. The sort of stats are really sort of showing that, and we'd love to project it even further, to be honest. We spent a lot of time working on our videos, on the structure of it. We've bought new kit to really enhance the audio and visuals that we provide. I've just realized we've got this on 2x speed, so it's probably quite difficult for people to take in. But yeah, do head over to this address, which hopefully will pop up any second now. There we go. Down in the comments to take a look. We're super proud of it, and we've got a lot more of these coming. So let us know if you've got any comments on those.
Cool. On to fund capital raising. So Ben and I over the last few years have had meetings with funds and bond raisers and family offices and private equity funds and of the like, because basically every time we fund a development, we go back to the courting of investors. We now have a list of about 100 investors, about 20 to 30% actually probably more than that, we've worked with. Most of our investors we work with once over and over again once they invest with us. So there's a lot of time invested in capital raising in our business. Remember, we are property developers. That is what we are best at, is not necessarily going through all of our investor decks and seeing who is the right investor for us, but also that particular project, and also, more importantly, in funds at that moment in time. So now that we've built up a reputation and quite to a certain degree built up 63 transactions and paid back the majority of the deals that we've done, we are going out to do a bigger capital raise so that we have more of less time focused in this area with a large player, so that we can keep rolling that investment and stick to what we do best. We have 3 openings available, and I suppose one of the reasons that we're bringing this up, and we did touch on it last week, is we actually shout out to Harry, had a really positive introduction off the back of bringing this into our live last week. So thank you for the introduction, Harry, and anyone else out there, if you can help us get in front of the right people, that would be great. I'm sure there's a lot of Zoom calls ahead of us, but we're splitting it in 3 parts. One is the social portfolio. As mentioned, we are looking to hold. So that's securitized income that's government backed, obviously great ESG credentials, tenants paying rent every month. And that is the portfolio that we shared earlier today. We are also looking for a larger pot to play with in XP Property. We are now delivering, I think, about 100 beds, 100 units or flats and houses over the next 14 months in delivery. And every single deal that we funded is a standalone, one investor, one SPV, which is its limited owned company. And then we do the deal, but we're looking for more of a commercial outfit that can support us across the group, to be more aggressive in buying, because we don't always have the most competitive stance in buying, but also give us the time into the development, so that even though our schemes obviously have a profit return, and we're more than happy if anyone wants to inquire about our average rate on gross development value, or our average return on an IRR basis, which we believe is a very strong rate, and we obviously back ourselves, but to support us doing that much more better and much more fluid. So that's the other area we're looking to capital raise, and we're sort of blending this all into one if one party wants a diversification across the 3 businesses, and then also buying more privately high yielding HMOs, which we have delivered almost 100 beds of, and we will continue to do so.
Nice. Yeah, I think we have a real diversity. I mean, those 3 options there, from a development perspective and a risk profile perspective, we feel like we reduce the amount of risk that we have within our business by offering that type of spread. So let's say the securitized income may be on a 5 to 7% return basis. Our high yielding HMOs might do anything from 8 to 15%. And then our developments are much more at the sort of 20 to 40% return. So you've got a real spread of risk profile. So venturing into those 3 sectors as a company, we think is a great way to to spread risk. So we're looking to kind of raise a larger sum to go and put into those various pots, and hopefully give a decent return to an equity partner that comes in, or any sort of fund that comes into our business. Cool. So I met a surveyor called Chris at Colney Hatch Lane in Muswell Hill this week to do the valuation. I didn't want to go into it too much. I just wanted to raise awareness for those that missed episode 26. We did a full sort of 3-4 minute breakdown of what goes into our valuation decks and how we present our properties in the best light possible to get the highest valuation possible to surveyors when they come and value our assets. So fingers crossed, over the next week, we get a valuation of the 9 flat conversion that we'll be embarking on at the level that we expect it to be. So watch this space. Hopefully next week we'll be talking about where that valuation came back in. Want to take this one?
Yeah, cool. So as you can see, and you might have seen in the previous episodes, this is our 6-unit development, which was mixed between a conversion and new build. When we bought the site, we bought it with a investor who gave us the equity on a fixed rate coupon, and we bought it with a bank to do the purchase and then fund the build costs in arrears. The total facility is about 1.5 million. You guessed it, you've read it there in front of you. And we're coming towards the end of the scheme, and we are actually talking on the next slide about selling the units. But we have sold 4 subject to contract out of the 6 in what I would say probably quite a difficult market. But what we wanted to touch on today is we're actually exiting this with some sort of exit finance facility. They can be called exit bridges, but I try and not use that phrase because I think bridge has a bad name in the industry, but they're very much far removed from what they used to be. Bridge used to be something that people take out when they were in dire straits and needed something urgent, but they're aggressive, they're quick, they're high loan to values, and you pay for that. But they've actually come down to a similar sort of level to what development facilities are anyway. So we've decided to refinance the site onto a exit finance product. What that means is we have a new bank, something you could use the same bank, but a new bank that come in and lend on the gross development value now the site is finished and you've got sales going through. The benefit of that, the main benefit for us, is because we have a blended finance cost of our purchase finance, which is the bank, our build, and the equity lender who is actually on a coupon, and a fixed coupon, is actually cheaper for us when you blend all of that cost. So we're basically refinancing out our costs as a minimum. And that comes at a cost. So you work out what's cheaper, stick on what you're at, or go on to something new. And for us, because the investor slice sits up on that loans cost, it's actually cheaper for us. Other benefits: as the units sell, you can pay down the exit finance, and as units sell, you can sometimes recoup some of the profits as you go down that ladder. So it's very well geared up for tailing off the end of sales and tailing off the end of a development site. So that is why we have refinanced that. Anything else to add, Ben?
Yeah, we've negotiated or discussed with the lender to effectively, when their loan to value reduces lower than 60%, we can take 20% of any future sales proceeds, which is great for cash flow from our perspective. That cash goes straight into the business, gives us an opportunity to then use that cash on future purchases, and keep us moving. So yeah, the lender on this one is LendInvest. If you would like any feedback on sort of them as a lender or the process, comment below and we can talk it through. But yeah, it's been a good process. We were hoping to do it today. It's now 5:30 and I haven't seen a notification say that it has been done. So Monday, Tuesday next week, we hope to have that over the line. Cool. On to sales tips. So, we've, like Jack says, we've sold 4 of the 6 now, which is great. We literally had the sales memos and the reservation fee this afternoon come through for the 4th sale, which was house 1 down here, which is the most southerly house. Both the houses sold for around asking price, £5,000 below asking price, which is great. Flat 3 sold for £15,000 over asking price. and flat 4 sold for sort of £10,000 under asking price. So, people have been seeing lots of headlines with house prices at the lowest they've been in a long time, things struggling to sell. We haven't necessarily found that here. Over those 4 properties, which is about 1.6 million in gross value, we've dropped £5,000 off of our asking price. That's great, absolutely brilliant. And flat 5 and 6, which are the upstairs 3 bedrooms, will hopefully follow soon. So, how have we achieved that? How have we sold sort of as quickly as we have? And we're going to talk through some of those now. So we've gone with a single agent up to now, but to try and shift the final 2, we are going to bring in a dual agency, and I've spoken to a number of developers that do that from the get-go, and I think going forward we probably will go with a dual agency, get a bit of competition going between those agents. They're both pushing to try and get those sales through. Just gives people a bit more of an incentive. Jack, do you want to take the hurdle and performance thing?
Yeah, cool. I've got a comment on this 1 or 2 agents. For anyone out there listening that hasn't instructed 2 agents before, there's a few different ways that you can structure the fee. 3 different ways I'm aware of. So there's one which is a 50-50 split. So it's sort of they're fighting for their ego and their presence in the market, but equally they get half of the fee whether they sell it or the other agent sells it. That is probably my least favorite out of the 3. The second is a 75-25 split. So the agent that sells it actually gets a higher fee than takes it out of the pocket of the other individual, but the person that's put it in their shop window, spent time on it, are selling it, they still get a 25% fee. And then the last but not least, which is very, very rough, which is winner takes all. So if you don't sell anything, you don't get anything off the back of it. So 3 ways to structure having 2 agents, or maybe even more than 2 agents on board. You might want to also look at, if you do dual agents, 1 local, 1 national. As we are in commuter belts, it's sometimes very good to have a London-based firm selling your stock as well as a local-based firm. We're currently represented by a local-based firm who have sold the 4 that we have with us. Hurdle and performance rate. We find that estate agents are salespeople and they back themselves more than the developers back themselves. So when we're walking around and agreeing pricing, guide pricing, if they sound punchy, agree a sort of hurdle rate and a performance rate. So we are selling a house in Central Suites at the moment. The agent was confident we'll get over 675, and I said, okay, I will pay you 1% if you get over 675, but I will pay you 0.75% if you do not achieve that. It gives them a performance to get better value for you and back themselves. Marketing and price, I'll take this one for you, Ben. Mm-hmm. So I've been told by a lot of very experienced estate agents, Tyler Newman being one, there's 2 things that sell a property. It's the marketing or the price. If you believe you have the marketing done really well, so you've maybe got a Matterport walkthrough, you've got CGI dress, which we're coming on to shortly, photos look really good, and you can't be anywhere else on Rightmove or whatever it may be, and you're still not getting viewings, it's most likely the price that's wrong. So we acknowledge that on the 2 flats that we might have overpriced on that site that you've just seen. And we believe the marketing is as good as it can be. So we have reviewed the price on those. So don't be afraid to acknowledge that and have that difficult conversation with yourself, because we know what it's like. That is your profit margin, and review the price if the marketing's good. If the marketing's not good, you might not need to change the price. And that is probably taking the words out of Tyler's mouth. One thing I would say on beating up agents on their fees, if you are paying them a dog rate fee, they might not actually be motivated to sell your property. So pay salespeople due where their service is due. If you're beating them up and I've heard horror stories of people paying like 0.25 or 0.5%. That's all well and good, but you get what you pay for. So you may find that if you knock their fee all the way down, you're not actually getting them boosting it, doing a featured ad, doing a video walkthrough, posting it on their social medias, calling their database for buyers between that exact value that you can sell. So don't chip them on their price if you feel that they will be motivated to get that fee in. Over to you, Ben, on staging.
Yeah, nice. So staging wise, we've taken a 2-pronged approach with this project. We have bought furnishings from Loft to stage 1 of the 6 units, which is this property here, which does look amazing. When you go into the property, you can get a real sense of what it's going to be like living there. But what we've also done is taken professional photos, and we have virtually staged every single property that we have for sale. So we've physically staged one, so the furniture is actually in the properties, and then every other flat we have had virtually CGI photoshopped professional photos to, again, get more people through the door. People can't envisage what something looks like. They can't envisage 3D spaces. They can't envisage living there until you actually put the property full of furniture. So getting photos CGI'd will get more people through the door and give you a better chance of success with your sales. And then comes on to incentives. So I've been having these discussions with the estate agent all this week. We have been talking about SDLT potential offering. So, paying for the SDLT for potential buyers. We've talked about reducing the reservation fee. The reservation fee that we took today, we halved because it was a good negotiating tactic. We'll say, look, well, we'll take £2,500 instead of £5,000 if we can get this done today and move forward. So, are there ways in which you can incentivize any potential buyers to buy your property? So that's, a couple of really good tips when selling your properties. If you've got some really good ones that we've missed, drop them in the comments below. We're always open to learning, and the sooner we can get these sold, the sooner we can move on to the next scheme and get the money through the door.
Cool. On to probably quite a comprehensive topic for later on in the live, but stay with me. It is really valuable, and it will save you thousands and thousands of pounds. I can guarantee that if you put this process into your business. We've seen from my legals tracker, from all the little hacks that I've been doing in the last few episodes, of things where come from a pain point and we produce something that resolves that pain point. So investor heads of terms, what are they? It's a document where you and the investor put everything that you've agreed verbally or even over email in one document, so it's easily explained, easily digestible, and approved by both of you. This came from a pain point when we would instruct solicitors, having had a verbal agreement or an agreement over email, and things just weren't getting put into the documents that were correct. And we're back going into the commercials and negotiating on our solicitor's time, which could be 200, 300, 400, sometimes £1,000 an hour. So heads of terms is to negate all of that back and forth through legals. You agree this one document that's completely transparent with each other so that it's not going back and forth. So it saves you time, saves you money, and saves the confusion. The way that we set these up, and I'm going to rattle through these because you can pause this back if you want to come back and watch this in the future. We set them out by the assignment, which is the lending rate, so how much money is being borrowed or lent, the rate that's being charged or the equity that's being offered, or both. The timelines, this is the timelines to get the deal closed, this is the timelines to get the money in, this is timelines for the deposit to come in, this is timelines for completion, this is also timelines for how long the project is due to take, a long stop date, what happens after, etc. Registration and security, what security is on offer, so whether that's first charge, second charge, personal guarantees, third charge, your pet that you're putting on the line, whatever it may be. Fees, who's paying for what? We always cap our investors' legals because we've had it before where they get carried away, they instruct a barrister, and 12 grand later they've signed one document and that's it. So we agree fees up front, but we're paying for their legal fees, but that does have a cap. So be sensible, shop around, yada yada. Exit, what does the exit look like? What does this sort of payout process look like? What happens if you have to refinance and hold it? That's all detailed in exits. And then finally, legals, we put our both solicitors' contact details, name, phone number, email, website, postal address, all on this document. So there's no confusions in 2 months' time when you're coming towards completion and you can't get hold of their solicitor. You've got all of their details there and then, and that is what we do with all of our investors. They love it because they can digest it in a one-page, well, it's normally 2 pages format, and it's all agreed. And when I ever send this out, I say, don't worry about how many iterations we get through on this. I just want it completely solid so that we're both happy before it goes to solicitors. Then when it's done, all you do is you take the contact details for both solicitors at the bottom, send an email CCing and all, attach this document, and everyone knows the complete assignment and agreements.
Excellent. I'm sure we could talk about that quite a lot more, but if anyone's got any questions on heads of terms agreements, then comment below and we can go through it another time. Residence meeting, this was interesting.
So this one was just a bit more fun and probably not as educational, or maybe educational as you might think. So we Central Suites own a property in an estate that was built in the 50s. And when that estate was built, there was 60 houses built and 42 flats built. We basically, there was a residents meeting, not an AGM, a residents meeting, because there was 2 points that needed to be discussed. One was a Section 5 has been served on all of the leaseholders, the 42 flats, and they need to decide whether, and a Section 5 is where the freeholder owner would like to develop or sell the freehold for development, and it gives the leaseholders an opportunity to buy it off the freehold owner. The freehold owner is an individual who inherited it from the original developer, and we basically had 80 people in a room. And on this point, it absolutely amazed me how unwilling people, normal people outside of our world, are unwilling to spend money to potentially benefit in the longer term or the bigger picture. And we were quabbling the group were quabbling over potential legal fees to get a better position in the race against the opposition, which is a freeholder and developer. And it completely amazed me how difficult that was. The second point of the meeting was to discuss basically who should pay for what within the estate, because it's on 2 titles. You've obviously got the freehold owners of the properties, and then you've got shared communal areas, and then you have the freehold which the flats sit on. This one was actually extremely comical, and I didn't get bored once. I didn't skip a beat on watching it. It was almost like a debating show between all of these neighbours, and it was hugely enjoyable. And what I found most enjoyable is you had the stereotypical different characters. So you had the loud and flamboyant, you had the quiet that speak up if they don't really like someone. It just turned into a huge debate. And the conclusion is neither points we agreed on anything. So it was, you could say it was a complete waste of, I think it was 3 hours long of my Wednesday evening. But I actually really thoroughly enjoyed sitting there and watching it. I didn't speak at all, even though I probably knew more than the average person on Section 5s and developments and land values and things like that. But yeah, hugely comical event.
Good stuff. Yeah, good insight there into classic NIMBYism and people with too much time on their hands. Just get a couple of Q&As. We're going to spend more than sort of 3 or 4 minutes answering these. Tony, at the end of last week's episode, when we were talking about assisted sales, asked us, how do you manage seller opinion on what should or should not be upgraded? I think fundamentally, yes, they may well own the asset, but you are the professional developer coming into that situation. So as far as I'm concerned, in our JV agreements, typically those decisions are down to us. We have the final say on anything relating to the development itself. That's what you're being brought in to do. That's your expertise. So yeah, it's not. We try to strip out opinions, and in the JV agreement state that final decisions on any development matters are over to us. I think that's about the line we take.
Yeah, completely. Should we jump on to one of the other questions? So I had a question from Chris. Thank you for asking this question, because it's very relative to XP surveys and XP property. So a Matterport 3D tour is one of those walkthrough tours that you'll see in your property. XP surveys do a fantastic job of this. So if you ever need a survey or a Matterport, speak to us. We'll do a cheaper Matterport if we're also doing the survey. But Chris asked basically about the annualized cost, because it does cost a server for Matterport and a photographer, for an example, because they tend to be the most common users of Matterports, to basically host that product annually. So there's the original cost and time of shooting it, and then there's the subscription that goes onto it. And basically, Chris was asking, was she being taken up the garden path and overcharged for it? What we tend to do in our business is we give 3 months rent free and then charge £10 per month per Matterport. And we have, Central Suites have got an album full now of all of our Matterports, because we can relet rooms without doing viewings. For architects, you can, look at what the building looks like, walk through it, picture the building again, come back to it if you haven't looked at it for several months.
Take measurements.
It's really good for befores and afters, floor plans. There's a lot that Matterport can do, and I think the photo walkthrough is just one element of it. But I hope that answers Chris's question. Mm-hmm. And then onto a question which which Nadia actually posted on Facebook, and I commented on the post, but I thought I'd share it with our listeners because I think it's very, very, very relevant at the moment, given a base rate yesterday. And for podcast listeners, we are the 4th of August, 2023 today. Well, I suppose everyone that's watching this might want to know that date. So the question is, if you have a buy-to-let mortgage due in January 2024, would you go for a 2-year tracker or a 2-year fixed? Currently and in today's market, and obviously you could seek your own advice from your brokers, Nadia's best rate at that moment in time was 5.89% per annum. My comment was basically this: if I've got a project that's coming to its fixed term in January, and we've just had a base rate rise of 0.25%, and we've had 3 base rate rises in the last 8 weeks, I would try and do this as late as possible and try and shoe it in, because I believe that if you are refinancing something in January, you probably have 3 months, 12 weeks until you actually need to pull the trigger and make a decision on that agreement in principle. I would leave it as long as possible because we are in a very moving market at the moment. One thing I would add, and I commented on, the last 3 prerequisite bank rate, I'll get out in a minute. Bank of England base rate rises. Third one ago was 0.5. The one before that was 0.5, and we've just seen a 0.25, so a quarter or 25 basis points rise. I feel that we are coming towards the top of that curve because there was 2 aggressive rises, 0.5 and 0.5, and now a 0.25. If they were really trying to stunt, what they are, which is confidence and inflation and the economy growth, then they would have probably put it up a 0.5 or even maybe more. So I believe that we would have seen another 0.5. So I believe we're getting near the top. But I caveated that with, obviously, she's getting terms of 5.89%. I don't think rates are going to be anywhere near soon going back down to the 1s, 2s, and 3% that we saw before. So what I would recommend is doing a cash flow analysis across the two and speaking to the right people, the right broker who does a lot of these trades and follows the economy, because they will be hugely beneficial. One thing I would be really careful of, and something we've seen really recently and absolutely quite crazy, and we actually talked about it in an episode probably 10 or 12 episodes ago, arrangement fees on buy-to-let mortgages are up to like 3, 4, 5%, and arrangement fees are like 5, 4, 3%. So if you're going in for a 2-year fix, look at the arrangement cost, because it might actually be cheaper on another product. So make sure that you're testing your broker on that. But for me, to come back on that point, I would wait 3 months. I would reassess where the market's at. And I would then speak to a broker over and over again until I got terms for both a tracker and a variable, a tracker and a fixed, and I would make the decision then. But currently, I don't think there'll be much in it. In reality, I don't think the market's going to move once we're near the top. I think it's going to sit there for a little while.
Excellent. Good stuff. Well, as always, thanks for tuning in. If you've got any questions that we haven't answered today, then drop them in the comments below and we'll hopefully touch on them next week. Thank you to Luca, who asked the question about CGIs. If you want an introduction, email us and see you all next week.